Hello, I'm David Frazier of Frazier and Mayer Research, LLC, and this is our daily Investors Monitor show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your financial market portfolio. So, we're recording today's show on Tuesday, August 25th, and I'd like to begin by sharing with you a few comments that I heard several so-called financial market experts say today on a few of the major financial broadcast shows. Those so-called experts, as usual, they assured investors that everything is fine in the economy, that there's no need to worry about their investment portfolios, that stocks will rebound shortly and will move higher during the months ahead. And most of those folks referred to this pullback in the stock market that we have experienced over the past few days as being a, quote, correction. I've always had a big problem with that term correction. Well, what is it that's being corrected? I mean, if stock prices are simply being corrected, well, there would be no need to worry. Surely we want stocks to be the correct prices. But then I think, well, wait a minute. Well, wouldn't it have been good for investors to know a few weeks ago or even a couple of months ago that stocks were trading at incorrect prices, that is, they were way too high, they were being overvalued, and that maybe they should get out of the stock market? Well, actually, that's exactly what we did do at my firm, Frazier and Mayer Research, LLC. We told our clients specifically, we said on May 6th of this year, on May 6th, only really a couple of weeks before stocks peaked, that, quote, our research indicates that stocks are in danger of pulling back sharply over the next few weeks. Now, we didn't get that exactly correct. It was actually took about 8 weeks for stocks to move substantially lower, even more than a couple of months, actually. But, we don't claim to be able to get the exact day or week when stocks will peak. We've never done that. But we've been very good at getting our clients and other investors who've listened to us in and out of the stock market at very important times. For example, to keep it short, I advised investors on September 18th, 2007 to get completely out of the stock market. That's only 3 weeks before stocks peaked and then moved approximately 57% lower over the approximately 14 to 17 months. I don't recall exactly the time period. It was from October 2007 to March of 2009. And by the way, many people say, yeah, but you didn't get people back in. Actually, we did get people back in the market. Only about a week and a half before stocks bottomed during March of 2009. And but I don't want to get a lot into that. This is not really to pat myself on the back. We all make mistakes. But what we do not do here at Frazier and Mayer Research, we do not tell investors to do what most money managers and advisors and so-called experts tell them to do. And that is, oh, don't worry, stocks will move higher over the long term. Well, the fact of the matter is, it's very important to avoid these big downturns, because if you do avoid the big downturns and then get back in the markets at the proper times, you'll make much, much more money than what you will ever make in the financial markets by just using a buy and hold strategy. Okay, now let's get back to what's been going on in approximately the past week. Well, I'm sure all of you that are listening to this show have heard the same thing that I've heard, that supposedly stocks are falling sharply because of what's going on in China, a big slowdown in China. Well, I find this very, very interesting. China announced on August 11th, only a couple of weeks ago, that it was going to devalue its currency. That supposedly has a lot to do with this downturn, not just the slowdown in China, but China's decision to devalue its currency on August 11th. Well, the fact of the matter is that the S&P 500 index actually peaked on May 21st. May 21st it peaked and has trended somewhat sideways for a couple of months, but really got back near that high again on July 20th and has trended lower ever since then. That's July 20th when the S&P rebounded back to its May, very close to its May 21st high. But that's several weeks before China announced anything about devaluing its currency. And in regard to the slowdown in China, well, there's been statistics that have told us for many months that there's a slowdown in China. So this actually has very little to do with what's going on in China. I mean, my gosh, the U.S. Gets approximately, well, let me approach it a different way. Of the total amount of exports of goods and services around the globe from companies in the United States, the U.S. only drives about 3.5% of its total exports from China. So, I mean, I could go on and on and on. The fact of the matter is, this has very little to do with what's going on in China. What it has to do with instead is the fact that the U.S. economy has been showing signs for at least the past 2 months of another substantial slowdown coming. And we have, if you go to our website, investorsmonitor.com, and just click on the news menu and go back, scroll down, you'll find that beginning in mid-May, just by reading news that we post on a regular basis, that you'll see there's been an abundance of negative economic news regarding the U.S. economy. Secondly, you can click on our various indicators on our economic monitor button that will show that and go through and look at charts of leading indicators, if nothing else. And you'll see these leading economic indicators, many of them peaked a few months ago and have been trending lower. Secondly, if you go to our website, once again, investorsmonitor.com, and go to the earnings monitor and put your mouse over the earnings monitor, bring your mouse down to earnings results and click on Q2 2015 earnings results, you'll see that, let me see, I'm going there myself to get the exact numbers for you. As of last Friday, August 21st, over 1,100 closely followed companies had already announced their second quarter earnings, and 63% of those companies beat Wall Street estimates. But we don't pay a whole lot of attention, unlike the major financial media and many so-called experts, about whether or not a company beats estimates. I mean, I tell my partner very often, an analogy I use is, let's say I told you that I own a basketball team, an NBA team, and a certain member of our team, boy, this guy had a great game. He extremely outperformed, did much better than what he normally does. You'd be thinking, oh, that must be a great player. And then I tell you, well, he usually scores 3 points on average per game, but this particular game he scored 8 points. Well, it's not terribly important about whether or not a company beats its Wall Street estimates. Remember, these Wall Street analysts are sell-side analysts. That is, they generally say positive things about a company. So, they'll simply lower their estimates to almost ensure that a company will beat their estimates. But if you look on that earnings page, you'll see that only 57% of those 1,100 companies' earnings were up during the second quarter of this year versus a year ago. And if you scroll through that page, you can find the earnings results for many companies. You can also go to the earnings monitor page on our website and click on earnings heat maps, and you'll see where we give a green color for positive announcements and a red for negative announcements. And you'll be able to see very easily that a very large number of companies, their earnings announcements were somewhat negative. Let me think of a couple other things I want to touch on real quickly. I don't want to make this video too long and get boring for you. I also heard today, a so-called expert, a very knowledgeable person, and he is knowledgeable in certain areas, claimed that the recent downturn in the U.S. financial markets, primarily the U.S. stock market, has nothing to do with fundamentals. Nothing to do with fundamentals. Well, that is completely false. It has everything to do with fundamentals. And that is what exactly I've been talking about over the past few minutes. And that is that an increasing number of U.S. economic indicators, including the majority of leading indicators that we follow here at Frazier Mirror Research, the providers of Investors Monitor, have turned negative. Secondly, the earnings announcements that I've just referred to, it's definitely not a big positive. And I could go on and on and on, but once again, we don't want to make this too long. Here's what I suggest for you to do. If you want to really know what's going on in the financial markets, I encourage you to tune into our free video show every day of the week. It's a daily show, and we'll tell you once again everything that you need to know. At least that's what we strive to do, but nothing more. We're not going to tell you a bunch of nonsense. So, what's going to happen from here? Well, my thinking is stocks are going to continue to trend lower. Of course, we're going to have updates like we did starting out today when everyone on the major financial shows was saying, see, it's already over. Everything's going to be fine. But then it turned back lower on the major stock market indices towards the end of the day. So the large number of indicators that we follow suggest that the economy here in the U.S. is going to weaken over the next several months. We're not going to fall into a deep recession, but it's going to weaken, and that stock prices are likely headed lower. So I thank you for listening, and I invite you to tune in again tomorrow.